Matthew Hassan, welcome to Property Insights, mate.
Thank you.
Now, you're a senior economist at Westpac Economics.
Mm-hmm.
That's a pretty famous place in the money markets. I don't know if you know that, but I know that. And of course, Bill is who's been on our podcast actually in the show. Bill Evans as the chief economist, or was now still is.
Yeah.
But has he retired?
He's moving to an advisory role in a few months.
Yeah. Okay. Now, please give me a bit of a scoop here. Okay. I'm saying, I'm going to put it out. This is a bet that he's been tapped on the shoulder by the treasurer or somebody, and to join the new RBA, the new advisory board, the RBA, in terms of monetary policy. And if it's not the case, I'm bloody hoping it is. Is there a scoop in there?
Oh, sorry, mate. I can't give you any information there. But yeah, obviously he's pretty up there in terms of his knowledge and background and
time
and the RBA whisperer for so many years that it'd be interesting to see where he goes.
I hope he is. I really do hope he is. So Matthew, tell me, what is Westpac Economics? So where does it fit within the bank, and what comes out of that joint?
Okay, so we are a team of about 6 economists. We sit within the institutional bank, so sort of the money market side of the business. But a lot of what we do is across the Westpac wide. So we obviously produce high frequency analysis and research that goes to the dealing room, to the traders, and out to Westpac customers, institutional base. We do a range of forecasts alongside that, presentations, briefings, and a lot of internal briefings as well as external briefings. For me, my sort of sectors are the Australian consumer and housing sector. So I tend to do a lot more on the sort of the retail side of things, whether it's briefing our mortgage broker network or our housing, home mortgage lenders, or our risk team or our credit team. The bank's pretty intimately interested in everything to do with housing. So my particular areas probably move more outside of that web space, which is sort of the day-to-day Aussie dollar interest rate moves that are particularly important.
The big question is, and I'm not going to talk about interest rates just yet, but the big question on everyone's lips is, how is it the Australian property market, and we're talking a national number, so I get it. There's Perth and Adelaide are a bit outliers, but how is it the national number has been able to grow, notwithstanding we've had a couple of 400 odd basis points of increases in a short period of time? How is it that property prices have been able to maintain their position?
Yeah, it's a bit unsettling, isn't it? I mean, I called it the uncanny rally that we've seen since the start of the year. It's really been undeterred by any of the RBA rate hikes. The clear underlying driver is this big shift in population. When you look market by market, the markets that have seen the biggest turnaround in price growth or biggest uplift are the ones that have also seen the biggest surge in population growth. And that surge is pretty strong. We're looking at, we think net migration is probably going to hit around 500,000 for the year to June. Which should easily be a record for Australia.
June 23, June
23. So
wow.
That's in the bag.
Wow, already?
Yeah, it's outstripped expectations every step of the way. It's at least 480, and it could easily top 500. Even that, though, is a little unusual. Like, you tend to look at population flows as something that would support the market medium term, rather than flow sort of straight away into prices. And okay, it happens in rental markets, but then sort of the mechanisms, particularly the RBA's modelling mechanisms, are more around tightening in the rental markets, driving up yields, drawing in investors. Then you get price growth. This is all front loaded. It's happened straight away. There may have been a little bit of some speculative front running of the RBA cycle. We've sort of seen lots of property cycles in the past. We know when the RBA is done, next move is down and property markets takes off. And there may have been a little bit of that interest in the market, but it doesn't really hang. We put a lot of emphasis on our consumer sentiment survey, and within that survey we have questions around interest rate expectations. And Australian consumers still expect interest rates to move higher. They're not expecting them to move lower anytime soon. So it doesn't look to be that. The other key element in the mix is really low on-market supply in most markets. So from where we sit, knowing what we know, population is really important. It looks like that's been enough to be a catalyst for price growth, even without those normal sort of lagged effects coming through.
Is there, if population is a driver of, let's call it the recovery in property prices in 2023, is therefore there an underlying assumption that the growth in those people who help grow the population, the people who come here, they got money to buy? Is that the assumption?
So normally that's a really small portion of migrant inflows making direct purchases. So it may be that there's a little bit of that. There's a little bit of just people out in the market observing that there's more people about in rentals and expecting that there'll be more competition for properties down the line. It's kind of hard to say. As I said, it's unusual. It's unusual for this population shift to have such a direct effect on prices. So it may be more shaping market expectations rather than direct buyers in the market. That is sort of one of the areas that's famously difficult to get a handle on, exactly the extent of foreign buyer activity. There's not a lot of good measures of the data. From what we can tell, it doesn't look to have it's not like it was 5-10 years ago, certainly. It may have picked up a little bit.
Do you think that, if I could just talk about something really simplistic in economic terms, let's just talk about supply and demand and what drives the two of them, in property prices I'm talking about. What drives, correct me if I'm wrong or you have a different view, but what drives demand is affordability. When properties have become more affordable, demand increases, obviously. Things that drive affordability is if my income's all of a sudden gone up pretty fast, which is not the case at the moment. Wages are not doing that on a sort of national level. If interest rates go down and the repayments per month have somehow come down as a result of lower interest rates, well, that makes it more affordable, therefore it increases demand. Well, that's not the case. We're around the other way. So you'd have to say demand's probably decreased. Wages are pretty steady. We haven't had a lot of wage increase, sort of in that nice range, 3 to 4%. But interest rates have gone up a lot since a year ago or 18 months ago, or even since a year ago. So on the demand side, we're probably not seeing any increase. In fact, we're probably seeing a decrease in terms of affordability. But on the supply side, affordability is a lot less. And I just can't understand why there's not a greater supply property on the market. Clearly, this is a supply and demand. The prices are a big reflection of the price increases are a reflection of the low supply of new properties for sale or properties for sale. I just can't understand, and I wonder if you guys have had a look at this. On the affordability side, regarding supply, what's happening? Is it because people go and get a second job, or is it because people ask for more money from their boss, or they're working extra hours, or are they stopping spending money and they're just, what do you reckon it is?
Yeah, so look, firstly, I'd sort of break it down into a couple of different sorts of supply. So your on-market supplies is one thing, but there's also a big physical supply issue that I think is a big medium-term challenge for Australia now. On-market supply, from the research we've done, one of the elements that looks to be important for listings is the price spread. So the spread between upper, middle and lower price properties. And I think that's because obviously if you're going to list a property, you already own something. And so if you're going to do a changeover transaction, then a big part of your affordability is not just the cost of finance, but the bridging, the gap you're trying to bridge between the current property and the one you want to buy.
Assuming you're going to buy more expensive.
Assuming you're going to buy something up the gradient. And so I think that was a big issue, sort of hangover from last year, that we'd seen such big rises at the higher end of the markets, and so that was sort of squeezing listings. But that's starting to roll out of the picture, and we've definitely seen over the last few months, or few weeks, months, that new listings have started to lift significantly. They're up about 20-25% from their lows, starting to rebalance with sales. As you said, the demand side is in terms of prices, it's moving. It's a price-led upturn that we're seeing, but turnover is still very weak. There's not a lot of people out there buying. There's just more people than there is stock on market. So that picture is definitely rebalancing, particularly in Sydney and Melbourne. Going forward, you'd expect that to continue because we have seen some narrowing over the last 6 to 9 months, some narrowing in that spread, and I think that's maybe why we're starting to see sellers come back out. But it's from such a low starting point. Now, if you go back, very long history back to the 1950s, the proportion of the dwelling stock that's being transacted at the moment is near record lows.
It's near record lows. So
yeah.
near record lows in terms of
the turnover in the market. Yeah, and
turnover.
And the suppliers are part of that picture, yeah.
Maybe we could just touch on this topic. There's been it seems to me, I don't know, it's just anecdotal, but it seems to be a lot of people downsizing. So, I got a house, it's gone up a ridiculous amount of money. I've had my mortgage for 25 years. I'm in my mid-50s. I'm not retired. I'm in my mid-50s. I sell my property for, let's say for argument's sake, $5 million, which I'd never in my life ever expected I'd have that sort of number. And I think, okay, well, I'm happy to buy an apartment, a nice apartment. I'll go pay 3 for that. I bank 2. But because I'm buying that apartment for 3, I'm now creating competition for that apartment at $3 million. So in other words, I'm dragging the price up. It might have been a 2 because all of a sudden there's a whole lot of other people similar to me. They're all trying to buy the same apartment because there's not enough properties for sale.
Yep.
So we're all trying to buy this nice new joint. Might be not in Drummoyne in Sydney, overlooking the water, or close to a railway station, whatever the case may be. Is that something you guys have had a look at, this downsizing and how it's driving prices, or maybe at least maintaining prices?
So there's a couple of parts of the market that are hard to get a good handle on. So I mentioned foreign buyers before. The other is this sort of it's called unencumbered buyers, where there's no finance associated with it. So it's not a lot, or cash purchases, you might want to call it. We haven't looked at it specifically, but I have seen research recently. I think it was from PEXA, that indicated, based off transaction data that they had, that part of the market may be quite large, in the order of 20-25% of purchases in the major eastern seaboard states. It did look to be quite stable. It may have lifted slightly over the last year, and it may be a bigger presence in the market given that other segments have pulled back so much. So first home buyers and other financed buyers have pulled back. So it may be that there's more visibility now around those transactions that are coming through. I was surprised at that share. A quarter of all purchases.
That's a lot.
Yeah, that's right. And the bulk of it is, as you say, it's people who are liquidating other assets, the family home, maybe even moving into retirement with superannuation funds that are funding these cash purchases as part of a whole sort of lifestyle change or change in living arrangements. But yeah, it does look to be a sizable portion. I think that's one of those things that you forget about. You tend to think of ordinarily, interest rates being the most important thing for a house purchase, that you've got to have finance. And so, when we look at the finance approvals, that's what's driving things. But there are these other segments that are able to tap into, large sources of other equity that are able to purchase unencumbered, and there may be more of a presence in this really illiquid thin market, I guess.
And they're very affordable. So because whether I bank $2 million in that example or 1.9, if I'm getting a really nice property, it's probably not that relevant. I'm happy to pay 2. I'm actually happy to pay $100,000 more.
Yeah, and you've got so much optionality, right?
Yeah.
You can buy when everyone else is struggling.
Yeah.
You don't have to worry about credit assessments.
Yeah.
You can wear a couple of bad years with interest rates in a market that's still sort of struggling. You're in there for 5-10 years. So perhaps that's a factor as well in the margins, that those buyers are thinking, well, now's the time, the best opportunity.
And I guess also those particular buyers, if they do come out with a couple of $1 million in change or change, they're going to put it on deposit with a bank and they're going to earn higher interest rates than they've ever earned before. So they're going to say, well, it's not bad. I'm still getting, I can still get 5% or 4.5%, whatever. And some of the hybrids that are floating around at the moment, they're getting 6s.
Yep.
And it's not a bad deal. So they can live off that.
Yep.
They've downsized. They've taken their own little mortgage that they had, got rid of that. They've got a nice joint, a new place, and they're living a new lifestyle. My gut, I just anecdotally I'm talking about this, but my gut feeling is that is driving prices to some extent, and of course prices are an average, so it's an average of every price, and it's misleading too.
Yep.
It's so misleading it kills me. What's doing well in Chatswood might not be doing well in Hurstville.
Yep.
in Sydney I'm talking about, and that applies everywhere. And I would like to talk to you just for a moment. When you guys do your analysis, how hard do you go about picking Perth out and making Perth sit out there on its own? And because it's been kept going up, but it's never gone down really over the last couple of years. Adelaide's the same. Although Hobart's around the other way. We all went too hard on buying properties in Hobart during COVID, and now Hobart's suffering a little bit more than everywhere else. And then parts of Sydney, there's about 20 markets in Sydney as it is, and Brisbane, and Melbourne's the same. I mean, how do you do that? And how misleading are the national numbers we keep getting fed by the commentators?
So I spend a lot of time digging around the detail around housing. That's sort of my pet hobby, really. And I think it's fascinating. And I think you learn so much from it because, the commentary tends to be very Sydney, Melbourne-centric, and even within Sydney and Melbourne can be really speaking to a couple of areas, really the auction markets, right, which are 15 to 20% of the market, and those markets tend to dominate the narrative. But I think when you look further afield, you get a much better sense of how some of these other dynamics are working. So population growth, for example. And you mentioned Hobart, right? I think that's the key to understanding, because Hobart has not seen an acceleration in population. It's seen a slowdown in population growth. And it's the one major capital city that has not really pulled out of its price correction just yet. It's still seeing price slippage. So I spend a lot of time because I think that's where the value is. And we also have a lot of the value we get is from our consumer sentiment survey, which has a range of housing related questions that do pick up this difference between cities and states quite well. So the national picture, bullish on prices and negative on time to buy, does vary quite significantly across the different markets. And we have seen every cycle has not been uniform. It's been a couple of markets that have led, others that have lagged. It's pretty unusual to get the sort of thing we had over COVID where every market was going full tilt. More often it's sort of these rolling cycles. And I think the key to there is understanding what's behind that and what's likely to be the next market leading the cycle. And I think you've picked on it already. It's clearly Perth. The other markets have exhausted a lot of the headroom around affordability, have been through big price uplifts relatively recently. And although most are still facing quite tight supply and demand conditions, Hobart included, it's no longer all that is required to drive price gains. Whereas you look at Perth, hasn't had a decent price cycle really since it sort of suffered through the mining investment slump. It's got plenty more headroom around affordability than most other states, and its state economy is so well placed. It's state government's in surplus. It's
only state government in surplus too, by the way.
Right, yeah. So there you go, and not just that. It's the whole mining sector is really still powering ahead at the moment, and of course it came through COVID relatively unscathed. So it doesn't quite have the population sort of resurgence factor in there, but for me, it's compare that to Brisbane, Sydney, Melbourne markets that have seen big run-ups in prices recently, don't have that kind of scope, I think, that Perth does.
Have you? I'm going to do two more parts of this, and the one that always fascinates me is the Gold Coast. I don't know if you guys have done much work just specifically on the Gold Coast, but Gold Coast has always been one of those places. It's always suffered. Whenever there's any slight corrections, always suffered. But for some reason, Gold Coast hasn't suffered this time around. Are we looking at Gold Coast and Brisbane, particularly Gold Coast? Are we looking at population increase driven demand that's sort of maintaining prices? Has there been a change in population?
I think it's a little bit too early to call it, but it's definitely the next foot to fall. So we know. We're already headed towards really tight affordability in the major eastern capitals. We know when that happens, behaviour shifts. People stop leaving the family home. They look interstate or regionally, and migration flows shift. And that'll be the driver of the next cycle, outside of what we've already talked about around Perth and so on. But I think there's more of a question mark this time around where they go. So price differentials are just not as attractive as they were for Brisbane. They may still be quite attractive for Gold Coast and Sunshine Coast, so that may be the ones that fill the breach. But it's not 100% clear to me that next migration flow, which may include more retirees than young families,
More lifestyle.
Yeah, lifestyle. There'll be young families and kind of affordability refugees in a sense in the mix there, but I'm not entirely sure whether they'll continue to flow to Queensland, which they have always, or whether they'll start to look in other areas regionally or so on. Regions are not that affordable either.
No, they haven't, because they caught up very quickly during the COVID period.
That's right, yeah.
My final question, because you guys, to me, Westpac has probably been the closest in being the most accurate on most interest rate calls in relation to the RBA I'm talking about, and to say when interest rates will stop and when they will start, and obviously led by your fearless leader, Bill Evans. Bill's probably been one of the most accurate over the last, he'd probably hate me to say this, but 30 odd years or more. But where's Westpac's position now? Because you have had a number of positions put out, and I mean, it's a dynamic market. The market keeps changing. But where's Westpac's position right now in terms of the rate cycle, not in terms of rate rises, but the rate cycle in terms of hold and reductions? Where are you guys looking?
Yep. So look, we think the hold will carry through to the third quarter next year, so September quarter next year, and then we'll get a series of rate cuts. It's been a difficult year for rate forecasters in Australia. The inflation challenge has been quite a different thing to contend with. And normally you'd look at interest rates, how they're affecting the consumer, how they're affecting growth. It's the labour market, what's that doing? And then that flows through to whether you think a pause is required. But this time around, it's more about seeing off this high inflation threat and ensuring that we're back on track to the 2 to 3% target. We've still got a way to go, and that does change some of the dynamics. So normally, the housing market, you take your cue from a soft economy, means next move will be from the RBA and it'll be a cut sometime soon. I think that inflation challenge means we have a delay. It's not going to be for another 12 months that they feel comfortable enough to ease policy, and they'll be waiting to see that inflation is truly back towards target, that they're not struggling with a wage breakout issue or some other low productivity driven unit labour cost issue before they feel comfortable to ease rates. So it'll be a little bit longer. It's kind of reminiscent of the, not nearly as bad, but reminiscent of the early 90s, when the RBA was first trying to really deal with a very, very bad inflation situation, a multi-decade inflation that they were trying to finally bring under control, and it meant they had to wait a long time before they could really cut rates enough to generate traction in the housing market. So it'll be a shorter version of that. We're talking 12 months, not 2 years, but that does change a little bit their thinking in terms of policy at this stage.
I have one more question for you, Matthew, if you don't mind. This is a little bit technical, but I think it's worth talking about because you just raised it, and I think it's important. It's sort of around unemployment, or the unemployment number. Again, it's a national number. It's it's not particularly accurate, but it doesn't really matter. It's the concept of NAIRU, N-A-I-R-U. Now, most punters, consumers don't know really what it means, but our new Reserve Bank governor has raised it a few times, and she sort of keeps, I've read a few of her publications, and she keeps talking about 4.5% being the unemployment number that we need to have. They've modelled, they think their modelling says they need to have in order to get inflation or keep inflation around the 2 to 3% territory. Can you explain what NAIRU is? It's a concept. I get it. It's not a real thing. It's a bit fictional, but it doesn't matter. But it's important.
Yep.
And could you explain what it is?
Okay, so it's a terrible.
It's a terrible word. I don't even know how to pronounce it.
Non-accelerating inflationary rate of unemployment.
Yes.
It's much easier to say NAIRU. Just say NAIRU. It's basically where they think the tipping point is for the labour market, below which you start to get wage growth accelerating, and then in turn that leads to inflation accelerating. So it's balance. 4.5 is about, this is the Goldilocks number, right? Not too hot, not too cold. We can keep things all on track as long as we don't get it.
4.5% unemployment.
That's the assessment. But as you said, it's notoriously difficult to estimate. Requires accumulation of evidence over time, and it changes. It shifts around. And this was the RBA's big problem prior to COVID, is that they were slow to realise that the Nauru had shifted lower again, and that despite what looked like a tight labour market, we just weren't generating any wage growth at all. In fact, wage growth was persistently slow. And we're kind of seeing the same thing happen again now, even though we've got 3.5%, give or take, unemployment. Wages growth has barely lifted to 3.5, 3.6. It's certainly not the 4s and 4.5 that you might have expected in the past when you had such a tight labour market. We know there's a bit more to come around that there's some inertia things, and some things in Australia move in slow motion. National minimum wage decisions, those sorts of things flow through slowly. So we know it's going to lift a little bit more, but even to get a 0.8 before that's happened, it's an annual of 3.6. It's really very little. It's again speaking to this issue that the Nauru may be lower again. I think there's the whole range of potential explanations as to why that's shifted, not a full understanding of why. But I think it's important for the RBA and the incoming RBA governor to continue to have a flexible mindset with some of these estimates, not to be dogmatic about estimates of things like the Nauru or trend productivity growth or unit labour cost growth, and to respond to the data as it unfolds. And at the moment, it's showing us that inflation's slowing quite rapidly. It's showing us that wages growth is benign, and that the most likely outcome is going to be that inflation's coming back under control quite quickly, and touch wood, by the back end of next year, we'll have some scope to ease policy as that flows through.
And I'll put you on the spot. In terms of net zero, where do you think, of course net zero means net zero official rate I'm talking about, where do you think we'll land, both with inflation and official rate? Now, I know net zero can be anything, but so where do you think inflation is going to be, and where do you think the official cash rate will be in 1 year's time?
Right.
In terms of net zero, do you think we'll get to 3.6 and giving us a net zero of inflation of 3.6 as well?
I think we'll be a touch above 3 by the end of next year.
Interest rate or inflation?
Inflation,
right.
And the interest rate, I think, will be starting to move down to around 3.5.
Okay, so we're getting close to net zero.
Yeah, we are. So I think the bulk of the inflation still looks really, I don't want to use the word because it got sort of tarnished so badly. It's sort of transitory in the sense that we had this post-COVID supply chain lockup that we'd never experienced previously. We haven't forgotten how to run supply chains. Once we've got past that, the global supply chains up and running again. We've still got some inflationary issues, so labour markets in particular,
services
in the services space. So that's why we're not expecting to drop into the 2 to 3% range. But I don't think we've forgotten how to maintain low inflation, and that once we've got past that flare up, I think people will become more anchored towards low inflation, and I think it'll beyond the end of next year we'll be back into that range.
Well, that's sort of suggesting 2 to 3 rate reductions, so I'm pretty happy with that. And because sensibly that's where we probably should be. I mean, in a sensible sense, we're not going to get 7 rate reductions and end up down at 2%.
That's right.
I mean, we're in terms of the official rate. So we're getting into sensible territory. We're heading towards sensible territory.
And I think the way I would describe that as a less restrictive policy setting. We know where we are now is restrictive. I know, setting to the housing story to one side for now. All else being equal, we're struggling with this interest rate setting. The economy's slowing, the consumers cutting back in per capita spending terms. So it's definitely a tight setting. Once the inflation threat is dealt with, you don't want to be running a tight setting anymore. You want to ease up on something. You don't necessarily want to go racing towards super stimulatory policy if you're concerned about labour markets or other inflationary challenges, but certainly there warrants some easing and restrictiveness.
Yeah, so a lot of people carry on about where we're at. I mean, I think given the inflation number, given we come out of COVID, given all the other stuff like this lack of population growth, now population growth, and lack of supply of properties, and just generally everything, I think the RBA has done a fairly good job. I mean, if I just look back at it today, where we are and where we're heading towards, who knows what sort of weird dynamics could happen between here and June next year. But it's not bad.
No,
relatively speaking, compared to the rest of the world as well.
I think a few months ago we would have been more nervous about the way the RBA's chanced their arm a little bit. They haven't raised as aggressively as the US Fed or the other central bank peers. They're taking a slightly more relaxed approach, I guess, to returning inflation to target. But on our current forecasts, it looks like they're going to achieve a relatively soft landing in returning inflation to target. All things considered, that's a pretty good result. So I tend to agree. I just want to bring up one point though that you sort of mentioned. We sort of haven't talked about it so far, but the physical supply and demand balance is a real challenge over the medium term. What we're seeing with net migration flows, close to 500,000 over the last year, that's the biggest net migration, population influx that we've seen running. So it's run so far ahead of new building. It's the biggest gap between population inflows and new building since the troops returned from World War II.
Wow.
It's a phenomenal surge in demand, and it's occurring against a backdrop of really low levels of building. And it doesn't look like something that's going to rebalance anytime soon. Getting new construction away, aside from interest rates and the property market, the cost side of the businesses and all sorts of strife. We're still seeing insolvencies running at a high level across the building sector. It's looks like the supply side's again not going to respond to this enormous surge in demand, and over the medium term, I think that spells for really challenging conditions. It spells supports for prices, but a very difficult environment for people looking to first home buyers or renters and so on. I think that's increasingly my sort of area of concern, I think.
Yeah, so and that largely comes down to policy at the end of the day. That needs government policy change or at least a view taken, and then that's pretty tough for governments to take those views because they can lose elections.
Yeah, absolutely. And I think some of this comes back to policy changes I think shifts in the wider environment that we saw through the back end of last decade, which really discouraged, I think, investors in the housing space, whether it's because they're having to pay a higher interest rate, whether there was the threat of negative gearing, whether there's perceived greedy investor out competing first home buyers, and I think that's added to this problem. And it probably needed to be tied more closely to new physical building to solve for it. But I think where we are now is we've had 5 years of really low levels of investor activity. I can't help but think that's contributed to where we're at with the rental market and the physical undersupply.
From my point of view, we're really lucky to have a senior economist come out of, to me, one of the great institutions when it comes to economics in this country, Westpac Economics. I really appreciate your time. Say hello to Bill and tell him hurry up and get on the Reserve Bank board. Thanks very much.